Let's cover the core order types you'll use in thinkorswim. Market order executes immediately at the current market price. This guarantees execution but not the price, especially in fast-moving markets. Works the same for entry and exit. Limit order executes only at your specified price or better. This guarantees your price but not execution. For entries, a buy limit is placed below current price waiting for price to come down to you. A sell limit for short entries is placed above current price. For exits, limit orders are your profit targets, where you want price to go. A sell limit above current price takes profit on long positions. A buy limit below current price takes profit on short positions. These are not protective stops, they're your goal destination. Stop order becomes a market order when price reaches your trigger price. For entries, a buy stop is placed above current price to catch breakouts. A sell stop is placed below to catch breakdowns for shorts. For exits, stop orders are your protective stops, where you don't want to be but need to get out to limit losses. A sell stop below current price protects long positions. A buy stop above current price protects short positions. Once triggered, it executes as a market order, which may fill at a different price than your stop level in fast markets. Stop limit order becomes a limit order when triggered instead of a market order. This gives you price control on protective stops, but carries execution risk. If price moves too fast through your limit level, the order may not fill at all, leaving you unprotected. Trailing stop, a dynamic protective stop that moves with price as it goes in your favor. You set a trail amount in dollars or percentage. As price moves favorably, the stop follows at your specified distance. If price reverses but doesn't hit the trailing amount, the stop holds that level. If price resumes moving favorably, the trailing stop continues to follow. This is a protective tool that locks in gains as price moves your way. It's not a profit target where you want to exit, but rather a way to protect profits you've already built while giving the trade room to continue. The order triggers when price reverses back to the trailing stop level. Trailing stop limit uses two separate order components working together. You set a fixed limit price and a trailing stop price. Initially, the limit price is above the trailing stop. If price drops to the limit first, it executes as a limit order and cancels the trailing stop. As price moves in your favor, the trailing stop follows it higher while the limit price stays fixed. If the trailing stop rises above the limit price, then if price reverses and hits the trailing stop, it executes as a market order and cancels the limit. Whichever level is on top triggers first and cancels the other order. This combines baseline protection from the limit with the dynamic profit locking of the trailing stop. MOC, market on close, executes at the market closing price during the closing auction. You're entering or exiting at whatever price is established at market close. Must be submitted before the exchange cutoff time, typically around 3:50 p.m. Eastern. Cannot be canceled after cutoff. LOC, limit on close, executes at the closing price only if that price meets your specified limit. Gives you price protection while participating in the closing auction. Must also be submitted before the cutoff time. These order types are available across stocks, options, and futures, though availability may vary by instrument and market conditions.